Hi everyone, welcome back to Books and Backbone. I'm Donna Harris, CEO of Bookkeeping Made Simple, your host. And today I want to talk about something I probably should have done sooner. Now, way back when I was very first beginning to podcast, I did actually do a video on this particular subject, but it's time to revisit it. And the subject is, what does a profit and loss statement actually say? Not in accounting terms. Not with jargon, not in the way it gets explained in a textbook or a CPA's office where you nod, and then you go home and you have no idea what you're looking at. In plain English, line by line, with real numbers, so that the next time you open a P&L or the next time your bookkeeper sends it to you, you actually know what it's telling you. Because here's the truth. The profit and loss statement is the most important financial document in your business. It tells the complete story of what happened during a period of time. Now, that period of time can be whatever you want it to be, but it tells the complete story. And most business owners either skim it, misread it, or avoid it entirely because nobody ever explained what it means. And today I want to fix that. Let's start with the basics. A profit and loss statement. It's also called an income statement. It's also called a P&L. You're going to hear these terms just kind of thrown around anytime you talk to an accountant or a bookkeeper, or even if you're watching financial news on TV or in a podcast. If you're watching financial news, if you're looking over at a financial, Bloomberg or something similar, you're going to hear these terms, and it's important for you to know them. So a profit and loss statement is also called an income statement. It's also called a P&L. It is the financial report that shows your revenue, your expenses, and what's left after you subtract the expenses from the revenue over a specific period of time. This period of time can be anything you want it to be. It can be a day, week, month, year, quarter, whatever. It can be this year to date. So I'm recording this on August 19th, 2026. So I can run a P&L from January 1st to August 19th. I can run a P&L from August 1st to August 19th if I really want to dig down into it. So it can be any period of time you like, but this is what's going to be kind of telling you the story. Usually it does take about a month to get a complete story. Most businesses look at a monthly P&L and a year-to-date P&L together. So the monthly tells you what happened in the month, and then the year-to-date tells you what happened from January 1st to the date. So if it was today, it'd be August 19th. The P&L answers one fundamental question. Did or did not the business make money during the period? But the way it answers that question, the layers of it, the sections of it, it also tells you a lot more than just, yes, I made money or no, I didn't. Okay, it tells you where the money came from, what it cost to generate it, what it cost to run the business, and what was left at the end. So let's walk through this section by section. The first section of the P&L is revenue. It's also called income, also called sales, also called the top line. Revenue, and I usually refer to it as revenue. Revenue is the total amount your business billed or collected during the period. This does depend on whether it's on accrual or a cash basis before any expenses are deducted. So if you sold $50,000 worth of services in July, your revenue for July is $50,000. There's a few things to notice as you look at the revenue section. First, is it broken out by service line or revenue stream? It should be. If your P&L has one revenue line that says sales, $50,000, that's not nearly as useful as if, like for someone in my industry, if it shows bookkeeping services, $32,000, tax preparation, $12,000, advisory, $6,000. You see what I mean? So that breakdown tells you what's actually driving the revenue and which parts of the business are growing, flat, or declining. The second thing we want to look at is the revenue moving in the right direction? Compare this month's revenue to last month's. Compare this month's revenue to this month last year. So for example, this is August of 2026, it's August 19th. I might want to look at July of 2026 and compare it to July of 2025. I also might want to take July of 2026 and compare it to June of 2026. Why? So I can kind of see what the trends are. Maybe in 25, June was a big month, and July was slower. And in 26, July was a big month, and June was slower. This is going to tell me all of that. Okay. We want to see the trends. So is revenue going up over time? Is it going down? Is it holding flat? Is it doing what you want it to do? Revenue as a single data point is interesting. Revenue as a trend is actionable. The third thing we want to know is, does the revenue number match what you expect based on what you invoiced or collected? If there's a significant gap between what you know you billed and what the P&L shows, you need to have a conversation with your bookkeeper. Something has gone wrong. It could be that she marked loans as income. It could be that she categorized something incorrectly. It could be a much more serious problem than that. But that's a conversation to have with your bookkeeper, and if they don't give you good answers, maybe it's time to look for another one. Anyway, below revenue, you'll often, but not always, see a section called Cost of Goods Sold. We call it COGS. Some people will call it Cost of Sales. It is almost universally called COGS, which is just the acronym. This is the direct cost of producing your revenue. So materials, labor, and other costs that are directly tied to delivering what you sold. For a manufacturing business, this is going to include the supplies, your inventory of supplies that you brought in to build things out of. And for easiness sake, I'm going to call the things widgets. It's what we do in accounting. You'll have a section called inventory or supplies. You're going to have a section called work in process, and then you'll end up with finished cost of goods sold. Some of that will show up on the balance sheet. I just want to kind of let you know that COGS can be very complicated. However, on the P&L, basically, COGS is the cost of the inventory you sold. Not the inventory you have, the inventory you sold. So if you have inventory of 100 widgets and you sold 10 of them in July, the cost of those 10 widgets should show up on as COGS. For a service business, COGS might be the cost of subcontractors you hired to deliver the service, or software license directly tied to client delivery, or other direct delivery costs. So one example would be like an auto repair shop. Their COGS would be the cost of the parts that they purchased specifically to put on a customer's car. It would also be the cost of the oil that they used, even though they probably have oil in inventory. For a beauty salon, COGS is going to be the cost of the specific supplies used for a specific client. So it's not going to be everything you bought. If you bought 10 packets of bleach and you only used 2, your COGS is going to be the 2 packets of bleach, okay? But it's going to be something directly tied to client delivery. In my case, it's going to be subscriptions for QuickBooks that I have historically paid for in the past for my clients. We don't do that anymore, by the way. It will be the cost of staff that is directly tied to client delivery. So bookkeepers, tax preparers. It's not going to be management. Management goes somewhere else, okay? And some of my staff are both managers and bookkeepers. So the portion of their time that is actually working on a specific client is COGS. The portion of their time where they're doing administrative work, management work is overhead. Kind of want to and we're going to go into this a little bit more. Software, my CRM software is not COGS, but a QuickBooks subscription paid for by my firm for the client is. Okay, by the way, we don't do that anymore. Anyway, not every service business is going to have a meaningful COGS section. Some of them have none at all. If you deliver your services personally and they don't have significant direct delivery costs, for example, again, a bookkeeping business where the owner is the only bookkeeper and the client is paying for their own QuickBooks subscription, it's not going to have any meaningful COGS there at all. It might even be zero. But what matters is that COGS, if you have it, is separated from your operating expenses, because the difference between revenue and COGS gives you something very important: gross profit. Revenue minus COGS, or cost of goods sold, equals gross profit. It's also called gross margin when it's expressed as a percentage. This is one of those 5 numbers I talked about last week. I think it was last week. And it's arguably the single most important number on the P&L. Gross profit tells you what the business earned before overhead, before rent, before sales, before marketing, before any of the costs of running a business as a whole. It's the profit from the core activity of the business, selling things or delivering services. So if your revenue is $50,000 and your COGS is 15, your gross profit is $35,000 and your gross margin is 70%. A healthy gross margin tells you that the business model is working. How do I know what a healthy gross margin is, Donna? Well, basically, we look at other businesses that are successful in your state, if not in your area, to see about what those gross margins are comparatively. Okay. I've been helping a friend analyze statements for a restaurant she wants to purchase. We are benchmarking that against other restaurants. What is the industry average, and what is this particular restaurant doing? And in one case, we found out that certain items were out of control. So that's how we benchmark it, in case you're wondering. We look at other accounting firms, other auto repair shops, other beauty salons, other whatever it is that your industry is, to kind of see about where are most of these businesses falling. And we actually want your gross profit to be higher than that, but that's the minimum. That's right where we want you to be. A healthy gross margin, it will tell you that the business model is working. A thin gross margin, where the cost of delivering the revenue is eating most of the revenue, is a signal that pricing, cost structure, or delivery models need attention. Watch your gross margin over time. A declining gross margin is one of the earliest warning signs that something in the business is drifting in the wrong direction. Again, we're talking about trends, not snapshots. Below gross margin, so you have your income section, your COGS section, and now you have operating expenses. And this is where all of the costs of running a business, other than the direct delivery costs and COGS, are listed. Your rent, utilities, marketing, software, salaries and wages for non-production staff, professional fees. How much did your accountant cost? How much did your attorney cost? That kind of thing. Office supplies, vehicle expenses, depreciation. These are the costs that you incur regardless of how much revenue you generate. We sometimes call them fixed costs or overhead, though in practice, some of them vary with revenue and some don't. A few things to look at in your operating expenses section. First, do the categories make sense? If you see an unusually large number in a category you wouldn't expect, that's worth investigating. Some of the things, like I've had clients just come unglued and say, well, you put everything in dues and subscriptions, and I don't think that's what it should be. And I was like, but you don't own software. Nobody owns software anymore. It's all software as a service. So this goes under dues and subscriptions because you're paying for a subscription. Used to be I would put that under computers, so computer and internet expenses. But today, most software is on a subscription basis, so we put it in dues and subscriptions. This also includes dues for networking groups such as BNI. It includes dues for professional groups. So if I join the AICPA, that's dues and subscriptions as well. But I want to kind of track how this goes over time. So in my case, I have a BNI bill that I pay every year. It's only an annual bill, so no worries there. I want to look at how that goes over time. So I want to look at this BNI raising their prices. Am I overspending on computer subscriptions, internet subscriptions, website subscriptions, I guess I should say. Am I overspending on that? Am I spending more than I should? Am I trying out a bunch of new software, deciding that I don't like it, and then forgetting to end the trial, for one thing? That's a huge one. I've seen a lot, but Any categories that are trending over time upwards in a way that's not proportional to revenue growth, we want to look at. Costs can often, it happens all the time, they creep up slowly and they can go unnoticed until it's a major problem. The quarterly review is where we catch this. Third, is your own compensation showing up here? If you pay yourself a W-2 strategy through your salary, through your S-Corp, it should appear under salaries and wages. If you're a sole proprietor or a single member LLC, your compensation may come out as an owner's draw, which shows up in the balance sheet rather than as an expense, which is why your net income will overstate your actual profit if you're not paying yourself a market salary. And I've talked about that before. So gross profit minus operating expenses equals operating income. This is also called income from operations, also called EBIT, or earnings before interest and taxes. Also, sometimes if a depreciation and amortization is not included, we call it EBITDA, which is earnings before earnings before interest, taxes, and depreciation and amortization. So you'll hear that term. In fact, there's a guy around here with a license plate that says EBITDA. I'm so jealous. So anyway, that's what this is. If we have operating expenses less interest paid into the business, it does include interest the business is paying out for cost of capital, because that is a business expense. But if your business is bringing interest in, we want to see what those earnings are before interest, taxes, depreciation, and amortization. Operating income, EBITDA, is a clean measure of how the business is performing operationally, stripped of financing decisions and tax effects. That's why we say we want it before interest. Interest the business earns goes in a different bucket. It's one of the numbers buyers and lenders look at when they're evaluating business performance. Now, below operating income, you'll see adjustments for interest expense. That's not true. You'll see interest expense in operating income. Why? Because interest expense on your credit cards and loans is actually an operating expense. There are other interest items that will appear somewhere else. We want to see other income or expense items. For example, if you got an insurance settlement, if you were in a wreck or if you had a fire at your business, you got an insurance settlement, that may or may not be taxable, and it's certainly not operating income, so we're going to put it somewhere else, and that goes under other income. Same thing if you have to pay out a settlement. If you're sued and you have to pay out a settlement, we don't want to count that as operating income. That's an extraordinary expense. So we'll put it under other expenses. At the very, very bottom, we have net income. The bottom line, what the business actually earned after everything. Now, net income is the number most people think of when they think of profit, and that's usually what it is. But it's actually the last thing I look at on a P&L, because everything above the line tells me the more about why net income is the way it is than the number itself does. For example, a business with $200,000 in revenue and $5,000 in net income is a very different business, depending on whether the gap is explained by high COGS or high operating expenses or a one-time extraordinary expense or significant owner compensation. If it's any of those things or something else entirely, it's a different business. Okay. The net income without the context is just a number. The P&L with all of its sections is the context. So how do you read this in practice? So you should be reading your P&L every month. Not an audit, a read. It takes about 10 minutes. Start at the top, revenue. You can run these, by the way, you can run these reports in QuickBooks and ask it to compare to a previous period. And you get to choose which period you want to compare it to, whether it's July of 2025 if you're looking at July of 2026, or June of 26 if you're looking at July of 26. There's several things we can do, but we want to start at the top, revenue. Is it higher or lower, or is it pretty much staying the same? Do you know why? If it's lower, do you know why? Did you lose a big contract? Did you start trimming clients and got rid of some of the ones that were problematic? Did you just have a low month? Why do you know why? You should know why. If you don't know why, you need to have a conversation. Move to gross profit. Is the margin consistent with prior months? By the way, again, QuickBooks can tell you the percentages. And if not, they're pretty easy to figure. But is it consistent with prior months? Is your COGS consistent with prior months? COGS by it should be, it is variable depending on your revenue. So is COGS in line with prior months? And is it in line with the revenue? If the gross profit declined, if the margin declined, why? Did costs go up or did the revenue mix shift? So if you're an accounting firm, you're going to see margins change from April to May and from the first quarter to the second quarter. Why? Because tax season ended. Because we have a lot of seasonal income in the first quarter of the year. So we should be able to take that into account. And I am using accounting because everybody knows when tax season is, right? Want to use accounting because one, it's the business I'm obviously the most familiar with, and because I think most people understand about tax season. Okay, so why? If the gross margin dropped, why? Is it because you had a couple of big months like we do in accounting during tax season? Is it because something else changed in the mix? Did costs go up? Did your COGS go up while revenue dropped? We want to look at the trends and then see if it's consistent with prior months. And by the way, if your business has been in trouble for a while, it might not even make sense to compare it to prior months. We might want to compare it to another business in your industry and then help you figure out how to get there. Okay? So we want to look at, did costs go up? Did revenue drop? Did the revenue mix shift? And then we want to scan operating expenses. Does anything look unusual? If you look and you're going, why did we spend $5,000 in meals last month? It's not a very good deduction, for one thing. But we want to look at that and see what's going on. Is there a number that stands out as being unusually large or unusually small? Because an unusually small expense can signal something too. It could be that you paid it twice in the previous month and we just haven't dated it correctly so that it's appropriate for that month. Is there any category that's significantly higher than you'd expect? Look at net income. Is it positive? First thing, we want it to be positive. Is it higher or lower than last month? Is it enough to cover your personal income needs after owner's distributions? Then ask yourself one question. Is there anything in this P&L I want to ask my bookkeeper about? If you do this every month, it's 10 minutes, and once you get good at it, it could be down to maybe 5. Just these questions. Your financial literacy will improve faster than any course or book could ever produce because you'll be engaging with your own numbers in your own business in real time. This, by the way, is how financial literacy actually develops, not from studying, from doing, from looking, from actually reading these reports and figuring this out. And I want all of my clients to be financially literate. The profit and loss statement is not complicated. It never has been. It's just not often explained in a way that makes a non-accountant feel like they can actually read it. And now you can. Because revenue, cost of goods sold, gross profit, operating expenses, operating income, net income. 6 sections, 1 story, 10 minutes a month. If you want someone to walk you through your P&L with you to explain what your specific numbers are telling you about your specific business, that's exactly what a financial clarity call is for. You can find me at mysimplebookkeeping.com. The first conversation's free. I'm Donna Harris. This is Books and Backbone. Open the report and read it. It's telling you something.